Welcome everybody to the construction insurance market webinar. We'll get started in just a minute, but to kind of get the easy stuff out of the way, if anyone has any questions for any of the panelists, click on the questions pane and enter your question in the text field. It should be on the right-hand side. The recording of this webinar is going to be sent to all in an email to all attendees. And yeah, we can get started with meeting our panelists. We'll start with Steve Bartell. He's a casualty broker who focuses in construction, real estate, manufacturing. And he's based out of the Chicago Burns & Wilcox brokerage office. John Dewart is senior broker specializing also in construction, real estate, manufacturing, based out of the Burns & Wilcox Chicago office. And Nick Enriquez is the casualty broker, also specializing in construction, hospitality, and it's based out of the Burns & Wilcox brokerage, Scottsdale, Arizona office. A couple of things that we're going to discuss today are the state of the construction market, some of the challenges you as agents may be encountering, or really what our view is of the outlook of Q3 and Q4 of the construction industry in particular, tips for brokers, and we're going to end with any questions. So reminder, if you have any questions submitted through the questions portal on the text field. We're going to get started to dive into the state of the market. So Nick, do you want to go first, and what exactly are you seeing?
Yeah, thanks, Brian. So the construction industry as a whole, we're seeing growth across almost all segments, despite the cost challenges that continue. And I think in the second part of the year, that's just going to continue. Despite the economic challenges that we're starting to see, or we have seen interest rates, prolonged high inflation, but the developers continue to be able to weather that, those conditions at this point. But with that being said, one of the reasons why we're still seeing growth is because the supply chain and labor costs, that the shortages that were there are just no longer there. And so the projects are not being slowed as much. So that's kind of a positive for the industry as a whole. We're still seeing primary GL markets that are willing to put capacity up. They are more interested in growing their books of construction, especially in the commercial space. And because of that, we're starting to see flat to modest rate increases across most segments, but obviously, there's exceptions to that, the tough classes, residential, street and road, EFIS contractors, scaffolding. So, and that's mostly on a practice basis. Project and wraps are a little bit more challenging, especially on the West Coast when you're dealing with any sort of residential. It's frame carriers are, kind of reeling from some losses that, is tightening capacity. More carriers are needed to be involved to complete those, wraps, and driving up the higher prices. So, yeah, that's kind of
Appreciate it, Nick. Pass it on maybe to Steve to add a little bit more insight also on the brokerage perspective.
Yeah, for sure. Thanks, Brian. So, as a whole, construction remains strong. Here in the Midwest, we're still, seeing a lot of money being pumped into infrastructure. Housing is limited, so we're seeing a lot of residential getting built. There's still a lot of activity going on in the construction marketplace. As a whole, from an insurance carrier perspective, we're seeing still a lot of regional, national carriers that are willing to put out GL, work comp, auto in a package. However, excess liability still continues to be a challenge as, more markets are pulling back their reinsurances, cutting limits, increasing rates, a lot of issues surrounding fleets, heavy auto schedules. So a lot of that activity is hitting the E&S marketplace. And unfortunately, with that, pricing for the excess liability has become a real challenge. A lot of activity that we've seen, recently is projects, mixed use housing, where someone's, putting up a 3-story mixed use apartment complex. So we've been writing a lot of, project specifics, excess, that goes along with those. There's certain classes of business that, a lot of standards and regionals have, started to shed, scaffolding, landscaping, any sort of crane, activity, bridges, street and roads. So there's pockets of industries that, a lot more regionals just, don't want to take a look at anymore. So that's been hitting the E&S marketplace. As a whole, you're finding a lot of standards regionals increase pricing by, say, 5 or 7%. E&S carriers are following suit, doing something along those lines too, following, inflationary factors. But, as a whole, it's a very robust E&S, marketplace. There's a lot of new entries into the space. Everyone's kind of, holding firm on their pricing. No one's going out there being, the person who wants to lowball things and really be that hot market. So, a lot of capacity, but everyone's holding a line and trying to write certain types of business and certain niches in the marketplace.
Thank you. To wrap up the market discussion, John, you want to add a little bit of color as well?
Yeah, absolutely. Thanks, Bryant, and thanks everyone for joining us. For context, construction is one of those areas that every market, when they enter our doors, knocking our doors, asking to partner, talk about different products, different lines of business. Construction is always an area of focus for our market partners, and it remains a focus of our company. The state of the market really continues to be flat or up. Obviously, the E&S market continues to see double-digit increases in how well we're doing, and that's no exception to our markets as well. So we are seeing, like Steve and Nick said, rate increases 5, 8, 10% plus, but it really depends on the class of business. Here where we are in the Midwest, it's very different from the West Coast, from the East Coast, from the South. Really depends on the class of business that we're trying to write. If it's a vanilla general contractor, if it's new venture, if it's a contractor with experience, it really varies. But construction is an area that lots of markets like to focus on and round out their book of business with us.
Appreciate it, John. We're going to change the question now this time to, what are you guys viewing as maybe the biggest challenge in the construction space specifically? We'll go backwards this time around though, so we'll let John go first.
Is that what was the question, Brett?
Biggest challenge in the space.
Right. So as I mentioned just a moment ago, the challenge really is in our space, depending on the size or complexity of an account, really is how we navigate the insurance market within the construction space. So if an account is fairly vanilla and it's fairly easy to underwrite, if it's small business or light middle market versus a true middle market or a large market account, it really can vary. But if it's something that's really easy to underwrite at our desks for the markets that we have to quote bind issue through our underwriting pens, that's one thing. But if an account has to go to market, then really it's a matter of making sure that that one submission that we get from an agency that we're able to solicit in the open market gets a look. So it's really a matter of rounding out the story of an account, making sure that there's a proper narrative, making sure that we have the proper accord forms applicable, a supplemental application if warranted, 3 to 5 years of loss history, but really ultimately the story. Markets are really deluged these days with quite a bit of volume of submissions. They want to partner with strong brokers like Burns and Wilcox, and they really want to partner with these strong brokers within an organization as well. So leading with a proper, well-vetted submission is paramount.
Steve, to you, what are you viewing as the maybe biggest challenge we're seeing, or maybe in problematic states as well?
Yeah, sure. Biggest challenges, again, it kind of goes back to this, auto focus, right? So if you have any sort of fleet, it used to be Dean's where, 100 units was like, a large fleet that people had issues with. Now, your street and road contractors, they could have 15 heavies, extra heavies, and your regionals or your standard markets don't really want to put up much of any capacity whatsoever. So really it's those really large fleets. Anybody with, 20, 30, heavies, extra heavies, you're having to come E&S. And then at that point in time, it's capacity. You used to be able to get 10 million in excess from some of your standard markets. Now, if you come E&S, you got a big fleet. Maybe you get 2. If you get someone lucky on a more innocuous risk from the GL perspective, you can get 5. But as a whole, it's really capacity issues. And then getting quality submissions out into the marketplace. Underwriters right now, especially on the excess, are being inundated with hundreds and hundreds of submissions on a daily basis. So you really need to put together a quality submission, call those underwriters and hound them. And then at that point in time, it becomes a relationship game to get that done. As a whole, there's certain pockets within the United States, Florida residential, obviously you got your New York labor law issues, Colorado has their issues, Texas with their uninsured subs. So there's pockets of industry and there's pockets of states that, bring their own challenges on top of having like heavy autos or some sort of, tough risk like a crane or a scaffold or, some sort of, tough industry. But, residential has obviously got its challenges, custom home builders that maybe build 10, 15 units. Those are easier because you have 15, say, markets. But if you get into a tract development, someone who, say, builds 100, homes, or a subcontractor that has, 100 starts a year, I mean, that really limits your marketplace down to 4, 5, 6 markets, something along those lines. But, for us in the book of business that we see, auto is just by far the biggest challenge. And then, of course, you can't get anywhere remotely close the same sort of rates like a standard. So, as a whole, if you can get a standard market to put up 1-2 million leads, I mean, that makes a world of difference. Or then we could do a 3x of 2, 2x of 3, 5x 5. So, it's really capacity. You used to see a lot more people putting out 10. Now they're putting out 2, 3, 5s. And then you have to layer that up, for contractual reasons if they have to, figure out a project or some sort of, need for a lender or, a large GC or a governmental entity. Yeah.
Appreciate it, Steve. Great insight there. Pass it on, round it out with Nick. Any challenges maybe you're seeing as well?
Yeah, I mean, I think the biggest challenge is still dealing with high premiums for insureds. Cost of materials, labor continue to go up, which is driving project costs up. So even if you're not talking about pure rate increases, their overall premium is just up. And then the other thing we're seeing a challenge with is audits. Obviously, construction, highly auditable class of business, and it's just difficult to forecast based on, the increased costs and everything that's going on. So, insureds are getting hit with large audits, or, you're dealing with, a premium that was probably overshot just because of, projects potentially slowing down, not starting. So that's the other thing, is just very difficult for our insureds to forecast exposures right now.
Yeah, your words were perfect for our next question. So you were talking about forecasting, and obviously insureds are having a tough time to do it. So if you guys really had a crystal ball on where you see the construction insurance market going for the next 6 months, Steve, where do you really see Q3 and Q4 headed?
I think it's going to continue to boom for the E&S marketplace. I don't see any of this, slowing down. Even in the last 6 months, you're starting to see again more of those regionals cut back limits. Pockets of GL primary are starting to head E&S. It's going to be, a little bit of a wild ride in some respects, and it has been ever since, call it 2018, 2019. But it's a continued acceleration. You've seen how much the E&S industry has grown over the course of the last, call it 5 years, and there's no slowing down by any means. That was one kind of interesting thing that, Nick brought up, but like these audits, we're even starting to see some excess carriers where there's large growth on certain infrastructure that even the first, 5 million or 2 million in the excess limit, some markets are moving towards auditable. Not a lot, but at the end of the day, if you're a large bridge contractor, you're someone who touches bridges where you have to head to maybe 2 or 3 different markets, there's a good chance that one of those 2 or 3 markets, if you've had large growth, are going to want to go auditable, versus the traditional sort of flat rating basis. So that's been an interesting sort of thing that's popped up in the last, call it 6 months that you're starting to see more of. But overall, I mean, it's good for us. It's tougher to sell to an insured in a lot of respects, and they're probably going to cut limit potentially if they don't contractual requirements. But overall, more things are heading E&S, and with the way that lawsuits are getting settled in courts, auto claims, the cost to adjust, the payouts, the liability payouts, things are only going to get more expensive and head more in the E&S direction because we're a little more able to adjust and be nimble with our marketplace.
Appreciate it, Steve. Nick, do you want to follow up on that?
On the tip.
Where do you see the next 6 months going?
Yeah. So for the next 6 months, I mean, same thing. I mean, I think we're going to continue to see the growth. I think that premiums are not going to be going down. Costs are not going to be going down. Carriers are still going to, tighten up their underwriting. And capacity is still going to be there, but the scrutiny over controls, risk transfer, everything like that is still going to be there.
John, you can go last. I don't know if you have anything else to add. I obviously know those guys can run a lot of it, but
yeah, I would just say, post-COVID, we've seen just an absolute uptick in folks, especially particularly as the cost of home ownership has gotten a bit more expensive. Putting a down payment down at a really very low interest rate. Lots of folks, doubling down on where they are living. And if you're a homeowner, if you're a renter, putting a bit of investment into your property. So, for all of us who write construction, we've seen just an absolute uptick in home remodelers, in homeowners and tenants putting improvements into their properties. And all of this, of course, carries a risk, element that needs to be contemplated. So it's important for agents to have that conversation with their insureds and their contractors and developers and flippers. But we've seen an uptick in that lately, but particularly in these summer and fall and late fall months where it's easy to and of course, obviously into winter, if you're doing an interior project, it's just it's easy to do projects within a home. Obviously, if the weather is hanging on, we can see a lot of street and road projects, of course, across the country. So really, of course, as we head into the late months of this year and into early next year and into the winter months, it's just important to be mindful of the projects that can be going on. But as Steve and Nick said, we just don't see any sort of slowdown in the industry. And if anything, it's just continue to get better and better.
Appreciate it. Next question, we'll get this one started with Nick, and I don't think you guys will have a whole lot, so we might not go to everybody on it. But what tips might you have for maybe some of your construction, agent clients for really what they should be doing to kind of differentiate themselves right now?
Yeah, kind of, as Steve has mentioned, any contractor with a large fleet, it's obviously kind of the biggest challenge right now. So I think it's really important that, we're speaking to the risk management plan. Do they have a safety plan, maintenance plan? What's the telematics? And that's great information, but we also need to highlight what they're doing with that information, because you can get the information, you can have the safety plan, but if you're not using it, our markets want to see how the insurance is doing that, whether that's, by giving a safe driver bonus, what's the criteria for when they coach a driver based on the telematics. So we're really looking to get more information on a risk management plan and how they use it.
Steve, do you have anything else you want to add to that, or?
If you're talking, tips for people, it's really tell us a good story. Why should an underwriter pick this up over the other 100 deals that they have on their desk? If there's a couple $100,000 or $1 million worth of losses, whether on your GL or your auto, what's the story behind it? What are you doing to mitigate that so it doesn't happen again? It goes back to the quality of submission, right? The more information that you can provide up front so we can have the story to explain to our underwriters is probably the most crucial thing. Of course, having a complete loss history If say there's, one shock loss from 2 years ago, can you get 8 years of loss runs? Can you get 9 years of loss runs to be able to show like, hey, this was one single fluke? As Nick said, telematics, driver controls, things like that when you're talking about heavy fleets. But yeah, quality submission. That's the biggest key to the whole entire story.
Perfect, appreciate it. So the good news is we're done with all of the layup questions that you guys that we already kind of knew about, but we actually do have some questions that have come in. So I'll just open this one out to the field and let whoever raises their hand first look at it. But when we're looking at COIs and some of the different addition changes that are then requiring, like construction companies might have requirements for CG 2010s or CG 2037s. How are you guys really kind of working around maybe some of those either requirements or not requirements?
Yeah, I'll lead with this one. So depending on the contract requirement, it could be an 85 version, a 1001, 0704. It really varies depending on who's requiring a particular form number or a particular form at all. So it's obviously really important for agents to be mindful of, as they lead in with a conversation with an insured, to be mindful of what form number and what addition number is required, and of course communicate that to us in the submission template. The last thing you want to do is get pretty far ahead with a particular market, only to at the last minute have to pull back because there's a COI requirement or a form requirement or a form year requirement that's exposed. It also really depends too, we've talked a lot about, different classes of business, types of businesses. A lot of the national builders out there, Steve, I think you might have mentioned this before, will require, just an absolute volume of language and particulars within an insurance policy. So, and there are only a few select carriers out there that will perhaps work with a, type of national builder. So really it depends, but as we've communicated, the story, the narrative, the summary is really important, but contract language is of the utmost importance too when you're talking about, conveying an insured's history and requirements to a market and having them quote.
And then I add one thing to that. So just one thing that I've been noticing more is that as of late, the CG 2010 and the 2037 have been requested a lot more often, on certificates. It's very rare that you're going to get a blanket 1001 form anymore these days. And it's really, you have to request specifically just a specified entity when it comes to that. Primary non-contrib waiver, subrogation, those are the other two sort of standards. Those are still easy to get, but the 1001 form has gotten much more difficult to get that on a blanket, and everyone's giving me like the 1219 or even the latest, I think it's 2024 or 2023 version of it all. Yeah.
Perfect.
I'd also add too that, excuse me, Brian, I'd also add to that when agents are, going after particular accounts and trying to, I always say, lift up the hood and see what, policy language, currently has, if it's general contractor or subcontractor. There are a lot of sort of like gotcha forms. And one of the forms that we try to screen is the CG 2294 form. It's a popular form that's fairly boilerplate for lots of, commonplace carriers out there. It's a really tricky form. It's a one-sentence form. I'd encourage all of our listeners and followers to Google it. You'll see a lot of horror stories, but the CG 2294 form is one that's, I regret to say, it's commonplace, but it's one that we as brokers and underwriters look out for. In addition to, like Steve said, a policy not including a waiver subrogation, primary not contributory, per project aggregate, and so forth. But different things that if you as agents out there, find yourselves looking at a policy with a prospect and uncovering these forms, that's important to say, hey, these are some issues and these are some things that our Burns Wilcox partners can get rid of if we're able to solicit your insurance in the open market.
Appreciate it. Last kind of question, and really anyone can jump in on this one, which is when we're talking about good submissions, You know, what does that exactly look like?
I mean, really, for us, it's accords with accurate payroll information, revenues. A supplemental app has become very key as people want to see what their breakdown of residential, commercial, street and road, you know, what kind of businesses are they, you know, servicing? What kind of construction work are they actually doing? Again, that 5-year loss pick, if you can get more and it's clean, that's always advantageous. And then, you know, going back to that story about, you know, hey, you got a couple $100,000 losses on there. Why? What's the story? How are you stopping so this doesn't happen again? And then safety manuals, employee manuals are key too.
And I'm just going to add a little step further on that. I think too, also providing, you know, your sub agreements, carriers are really getting picky on that. And they want to make sure the risk transfer is there because, you know, as Steve said, in certain areas, you know, uninsured subs are becoming a big issue. So we're really seeing scrutiny on that. So anytime we can get any sort of contract or agreement, it always goes a long way as well.
I'd also add to a list of states. You know, obviously, you know, we as a company, we have offices across the country. We work submissions across the country. For insureds, we're domiciled from West Coast, East Coast, South, and the North. But there are always those contractors out there who perhaps are domiciled in Illinois and may be focused exclusively in Illinois or the Midwest, but may try to take a job in New York City in the 5 boroughs. And that can be problematic for companies. In the same vein, you might have, you know, a contractor domiciled in Georgia who wants to dip their toes into the Florida market or Texas market. So, which all have different guidelines, different state requirements, and different licensing requirements and so forth. And our carrier partners will screen those states as well. So as agents prepare a submission to courts, supplementals, losses, et cetera, also a list of current states and prospective states that their customers work in is also appropriate.
Perfect. Hey, really appreciate the time. Nick, Steve, John, great insights. That's all the questions we have. Unless somebody has one and they type it in very quickly. I think that's it for today. And like I said, really do appreciate your time and your insight.
Thank you.
Thank you.
Thank you.